Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalysts talk. Today we're looking at Richtech Robotics.
If you find our talks useful, please consider subscribe, like, and comment underneath to support our podcast. And if there's any stock you want us to look into, leave it in the comment section below.
So let's get into the analysis. Richtech Robotics is a really fascinating microcap company. They're deep in service industry automation, so in hospitality, healthcare, retail, that kind of thing.
Right, and while the top-line revenue is still pretty small, it's the direction of travel that's interesting. We're looking at, maybe $5.1 million for fiscal year 2025, so about 20% growth year over year.
Exactly. So it's still very much a pre-profitability story, but the number that jumps off the page, the big operational signal, is the gross margin expansion.
I saw that. It's staggering, 75.6%. Recently.
Right, 75%.
For a company that makes physical hardware, that feels more like a pure software company number.
It is. And it's not a small jump either. We're talking over 1,500 basis points of expansion. That tells you they have incredible pricing power, or their unit economics are just incredibly strong.
Which has to be tied to their big strategic pivot, right? The RAS model, robotics as a service.
That's the whole game. They're moving away from just selling a robot one time. Instead, they're converting that hardware sale into a much higher margin recurring revenue stream.
So it's less about the initial sale and more about the long-term subscription and service contract.
Precisely. It stabilizes their income and, more importantly, just massively increases the lifetime value of each customer.
Okay, but a pivot like that costs money, a lot of money. How are they funding this? Is the balance sheet loaded up with debt?
You'd think so, but no. That's the good news. Their liquidity is actually quite strong. They've got almost $33 million in cash and a solid current ratio.
So no heavy debt payments weighing them down?
Not really. They've relied mainly on equity financing. Now, that comes with its own major risk, which we have to talk about, but it does increase their survivability.
And I noticed a little detail, over $1.1 million in investment income. That feels like a sign of good discipline with the cash they do have.
It's a great sign. It shows they're not just letting that cash sit there, they're putting it to work, extending their own runway while they build out this RAS model. It's smart.
Okay, so the unit economics look fantastic on paper, but what about in the real world? Is anyone actually using these robots?
They are. This isn't theoretical. They have over 450 robots already deployed. And what's impressive is how specialized they are.
Right, they aren't just building one general-purpose robot.
No, not at all. You have Matrady for restaurants, Adam, the AI bartender.
Medbot for hospitals, DSTE for commercial cleaning. It's a whole portfolio.
And that vertical specialization is the core of their competitive moat. It's built on, over a decade of innovation, patents.
But the real value is the data, I'd imagine.
That's it. It's the data flywheel. Every single robot out there is collecting data, feeding it back, and making their AI algorithms for navigation and tasks smarter.
A classic network effect. The more robots they sell, the better the software gets, and the harder it is for anyone else to catch up.
Exactly. And nothing proves that, like big-name customers. We're seeing their robots at NVIDIA headquarters, for instance.
Wow. If NVIDIA is using your AI robots, that's about the best stamp of approval you can get.
It's huge for credibility. Same with seeing them in Walmart locations.
Which leads to what seems like the biggest catalyst they have right now, that big agreement they signed.
The Master Services Agreement,
Yeah.
the MSA, signed in August 2025 with, and this is key, one of the largest retailers in the U.S.
And that's not just a trial run, that's a real commercial deal.
Right. This validates the entire thesis. It signals that deployments are about to ramp up significantly and revenue should accelerate.
Plus, once you're integrated into a retailer's operations like that, it creates huge switching costs. They're not going to rip you out easily.
They lock them in. And at the same time, they're already looking ahead to the next big thing, the humanoid robot, Dex.
Powered by the NVIDIA Jetson Thor platform, that's a pretty clear signal about their ambition.
It is. It keeps them right in the middle of the broader AI and robotics conversation.
Okay, so the bull case is strong, great margins, a smart business model, and some massive validation. But every story like this has risks. Let's get into the bear case.
There are two big ones you just can't ignore: profitability and dilution. First, the bottom line. The company is still losing a lot of money.
I saw the forecast. A net loss of around $15.2 million for fiscal 2025.
Right. And you have to ask yourself, how is that possible with 75% gross margins?
Exactly. The loss is nearly triple their projected revenue, so where is the money going?
It almost entirely comes down to one line item: General and administrative expenses, G&A. It spiked 269%.
269%. That's a massive red flag for the market.
It is. Now, management's explanation is that these are necessary one-time costs. They're building out the infrastructure, compliance, internal controls, everything you nailed to support massive growth and a big customer like that retailer.
But the market can be skeptical of costs that are labeled one time. The risk is that this isn't temporary, that it's just operational bloat.
That's the entire perception risk right there. They're betting that the revenue from the RAAS deals will ramp up fast enough to absorb these costs and then some.
And to fund all that G&A and R&D for DEX, they've been issuing stock, which brings us to the second risk.
Dilution. And we have to be blunt about it, it's substantial. They've had large equity offerings increase their authorized shares. Existing shareholders are definitely feeling that.
So how do you balance that, the pain of dilution now versus the benefit of having the cash to survive and grow?
It's a classic growth company trade-off. They're using that equity to fund the long-term vision, the RAAS platform, the DEX robot. It's much safer than taking on crippling debt.
Yeah.
So you're trading some shareholder value now for, hopefully, a much bigger pie later.
We should probably also touch on some of the recent execution noise.
Right.
The delayed 10K filing.
Right. They expect to file within the grace period. And crucially, they said the reason was complexity from their rapid growth, not a disagreement with their auditor. That's a key distinction.
Okay, and president resigning.
Also notable, but the separation agreement seems to suggest an orderly transition. These feel like typical growing pains for a company in hypergrowth.
So looking ahead, what are the next big events? What's on the catalyst calendar?
Two huge things in the coming months. First, that 10K filing we just mentioned, it's critical.
Because it's the first hard look at the numbers since that big retailer agreement was signed.
Exactly. We need to see if those 75% margins are sustainable, and if that MSA is starting to show up in the revenue line, that's the proof.
And the second catalyst is a bit more flashy.
That's more flashy. The DEX Humanoid Robot Showcase at CES 2026 in Vegas.
A huge media event that could generate a ton of buzz and maybe even some serious sales inquiries.
It's all about cementing their image as a technology leader. And from a technical perspective, the stock itself has been, well,
extremely volatile. A 490% surge, then some really sharp pullbacks.
it's a classic high beta growth stock. The valuation is all about the future. For investors who believe the RAAS story, these drawdowns might look like attractive entry points.
And the whole story is backed by some undeniable macro trends, isn't it?
Oh, absolutely. The tailwinds are massive. Labor shortages, wage inflation,
Yeah.
especially in hospitality and healthcare. That just makes the ROI for their robots better and better every single day.
It shifts automation from a nice to have to a need to have.
It becomes an economic necessity.
Okay, so let's try to pull this all together. Richtech Robotics seems like a classic high-risk, high-reward bet on the coming age of robotics.
I think that's right. The strength is that pivot to the high-margin RAAS model, which seems to be validated by a major enterprise customer. And they have the cash to see it through.
But the whole thesis really hinges on what happens in the next few months.
It does. It comes down to two things. One, can they keep those gross margins above 70%? And two, what is the rate of revenue acceleration from that big retailer agreement?
Because if they can do both, if revenue ramps while margins stay high, the operating leverage could be absolutely massive.
That's a whole bet, that the future leverage will be so great it justifies all the current risk and dilution. That's the calculation an investor has to make.
We hope this analysis of Richtech Robotics has been useful for you. If you want more analysis and catalyst talks like this, remember to subscribe, like, and comment to support Smart Wealth with Joshua.